Good evening, everyone, or good morning, wherever you're joining from. We do have quite an international group of speakers today, so I'm expecting our participants to be international as well. I know we have a lot of people who've signed up for this event, so we're going to take a little bit of time and let the participants join in. But in a minute, Alex will run our first poll to see, to test some of you. So the first poll question is, what percentage of your portfolio is in crypto? We would love to hear from all of you. What percentage of your portfolio is in crypto? Right, and the answer is 82% of those investing in crypto are going through Gemini or exchanges like Gemini. So Sunil will be very happy to hear this. So with this close of the poll, let's bring our speakers on. We have a very interesting group of speakers today. And, crypto is always a very interesting conversation with our investors, as well as, the public. And so it's a great time to sort of run a fireside chat now as part of the development of our crypto speaking series. I'd love to introduce our speakers. So the first speaker we have is Sunil. Sunil comes from Gemini. And what I'll do after introducing them is to have them introduce themselves, why they got into crypto and who they work for and a bit of their company. But Sunil is the Senior Principal of Business Development at Gemini based in Singapore. And Sunil oversees BD and partnership efforts in the region. Now, prior to joining Gemini, Sunil spent over a decade at Barclays as the Director and Head of Asia Pacific Commodities, and later as the Director of Macro Sales, with nearly 2 decades of experience with institutions such as Goldman Sachs and Merrill Lynch. The next speaker we have is John Deen. John is the CEO and Managing Director of the Trovio Group. Trovio is founded in 2017 and is an established digital asset manager and advisory firm in Asia Pacific and provides services under the TCM brand. Trovio also delivers a platform as a service solution for the commodities industry, providing tokenization and digital registry services. John sits on the Digital Finance CRC board, an Australian federal government funded research center into the commercialization of the future digital economy. Prior to Trovio, he was an MD and head of Asia Commodities Trading for JP Morgan based in Singapore and a board member of JPM Ventures Energy Private Limited. And before that, he was in London with a team working with vanilla and exotic derivatives trading business with a team based in New York, Singapore, and London. And last but definitely not least, we have Thomas. Thomas is Econex's head of Switzerland and portfolio manager of Bletchley Park Multi-Strategy Fund, which is a crypto fund of hedge funds launched in November 2019. Thomas has almost 2 decades of hedge fund investment management experience. And prior to Econex, he was the head of Alternative Solutions Group at Lombard Odier, one of Switzerland's largest private banks and pioneer in hedge fund investing, where he was responsible for a team of analysts and portfolio managers that ran research across strategies, regions, and fund types. Thomas had also held roles at Calibra, JP Morgan's Geneva Hedge Fund Advisory Spinout, and Bucefale Investment Management. Now, these are all sort of really interesting CVs, and all of you will notice, I mean, everyone comes from a very rich and deep banking background. So I think we can start with Sunil. Perhaps Sunil, you can introduce yourself, talk about why you joined the crypto world, and maybe talk a bit about Gemini and what Gemini is doing today in the crypto world.
Yeah, sure. Thanks, Zoe, for having me here. So a quick introduction about Gemini. I guess 82% of you guys are directly investing in crypto exchanges, so you would know Gemini, but it's a global regulated and secure exchange platform, as well as a custodian for both institutional and retail clients. As far as I'm concerned, I work as a senior director for business development at Gemini in Asia Pac. And I have over 20 years of financial services experience. I've spent pretty much all my life on trading floors. And I'm kind of very excited to be part of this whole new asset class, crypto world that's kind of coming around. I mean, for the last 5 years, I think, I've been very interested in the crypto space. I have invested. I started small and then, kind of built up my portfolio. And, increasingly sitting on trading floors, it became very clear to me that these financial services were going to be disrupted. You can see the utility of crypto. You can see how over time, things like transaction banking, things like payment services, etc. These are, I mean, of course there's going to be regulation and stuff, but these are probably going to be disrupted and very likely by crypto. And after COVID, and you kind of moved very quickly to the digital world, it was even more clearer to me. So hence I was willing to kind of bet my career on it. And so basically here I am.
Great. John, why don't you go next?
Thanks, and good to meet everybody. Yes, I'm John Deen. I'm the CEO of the Trovio Group. Sort of as mentioned in my bio, we do a range of things on the technology side, where our original technology originated out of a company called DigiCash, which is largely credited with actually inventing cryptography in the 90s with David Schwalm, and our CTO is actually one of the first ever employees there. So we have quite, I guess, a rich history in everything around the cryptography sort of side of the business. We do a lot of things around digital on-ramping of physical commodities, provenance tracking, ESG scoring, asset tokenization. We actually did the world's first public blockchain token with the government guarantee, which was BMGT. We now do a lot of things in decarbonization. So we use a lot of the skills and I guess IP that we have within our technology business and branch that over into our asset management business. Because to me, what we're doing in investing in this new asset class, it's investing in technology. So, when you look at things like DeFi and yield farming, understanding smart contract and smart contract risk and how to audit smart contracts is pretty critical to it. So that's really what we do as a business. We're building a new enterprise. In relation to sort of why I got into this, probably similar to Sunil, in 2016, 2017, I was running commodities trading at JP Morgan in Asia. We did a lot of stuff on the physical side of things, a lot of things on the financial side of things. Obviously, Bitcoin was emerging at that stage. I mean, it had a big run up, and it was obviously towards the late 17, it was very, very volatile, and there was a lot of talk about it. But you could see the real world application, particularly in physical commodities. And if you saw the evolution of this space back then, a lot of it was around trade finance, a lot of it was around repo functioning, it was like smart contracting, eliminating clearing and settlement risk, and you could see the commercial application. Where we are today, it's like mind-boggling, like DeFi and the disintermediation of the middle layer of all these financial service providers. I think, it's so exciting to be in this space. And, obviously the opportunities as investors, the opportunity for businesses that want to get involved. I think, right time, right place. And, everyone who's looking at it, I think you should go in, eyes wide open and arms wide and put your arms right around it. So it's very, very exciting.
Thanks, John. Thomas, and you?
Yes, hi everyone. Well, thanks for having me. So I'm head of Switzerland for Equinix. It's a global group, Nasdaq listed for roughly a year now. We basically share a common vision with both Sunil and John, obviously on the space. The company was created back in late 17, really with the global view of helping kind of broader adoption of digital assets. And we've really built multiple kind of vertical. I'll speak specifically about where I sit within the ecosystem, but our journey has been really about building that whole ecosystem very close to regulation, really to allow kind of broader adoption from the major institutional players. So we've built exchange, custody, borrowing, lending, a range of different investment and asset allocation solutions. As far as my journey is concerned, again, I think a lot of common factors, roughly 20 years of traditional finance experience, always been on the fund, mostly hedge fund kind of allocation perspective. So I'm always seeking for liquid alpha. And as you can imagine, and obviously it's going to be a major part of the topic discussion today, this space is very interesting from an alpha extraction perspective. So started the journey around mid-17, looking at all these inefficiencies, and ultimately basically decided to jump in with Equinix and created the sleeve of asset management via a crypto fund of hedge funds, which is what we've launched back in 2019.
Great. Thank you. Look, just a reminder to everyone, while this is a fireside chat, we will allow some time for questions from the audience. If you will go down to the Q&A button on the Zoom, I'm quite sure we're all familiar with Zoom Q&A buttons. Please key in your questions. You can either direct it to any speaker today, or it could be a general question, and we'll try and answer as many as we can. So I'm gonna kick off now. I see that I think a lot of us are quite experienced crypto investors, sort of, but I also see the space developing and deepening quite a lot. And, I think here we're talking about not just about directly investing, which is through exchanges like Gemini, but actually there's a whole development of crypto funds that's starting to happen. And so, John, maybe the first question you could kick off is, what are these crypto funds, and can you give us an overview of the space?
Yeah, sure. I mean, obviously in traditional markets, people allocate to crypto funds because they're looking for a way to sort of generate additional alpha in their portfolio. Obviously, you're giving it to someone that's going to professionally manage the asset class, has a deep understanding and knowledge of the asset class, and the expectations are that they will predominantly outperform how you would allocate your capital. So, people do allocate, whether it's in commodities, equities, fixed income, for these reasons. I think in the crypto space, there's a few other reasons why people look at the hedge fund space. One, it is definitely an emerging asset class. I mean, you're seeing a lot of traditional managers now get involved in it, but there's a sort of additional risks, right, that people generally aren't that aware of in crypto that need to sometimes be addressed. Some of those risks are, really just the unknown, right? How do you hold your private keys, right? How do you store your assets? And when you go into a crypto fund or any traditional hedge fund, you're obviously going to have a trusted third-party custodian, right? And Gemini can be a custodian of your assets, for instance, right? With us, we use actually Coinbase custody, and we hold our clients' assets in Coinbase custody on their behalf. We use third-party administrators. We use Mainstream actually in Singapore, and the administrator function is obviously proving and definitively showing that those assets are actually sitting there and they haven't been reappropriated to somewhere else. So for us, I guess when we look at a crypto fund and why someone would go into it in this sort of digital asset space, first and foremost, it's like safety and security of assets. The second part is definitely the additional skill set you get from giving your capital to someone that's deeply involved in the space, 24/7, and it is a 24/7 market in digital assets, not 24/5. And then the third party is, I mentioned before in my little intro that there's so many really exciting trends or emergent trends in digital assets. Like, I think the reason we're all associated with it is there's so much innovation going on, there's so much disruption. And when you're working with people that spend their life like dedicated to really looking at this space now, there's certain things where it's hard as an individual just to track, right? I mean, whether it's NFTs, whether it's gaming, yield farming, DeFi in general, whatever it might be, where do you want to play and how do you want to generate the best type of returns? And a crypto fund or an asset management business that's solely focused on delivering that sort of exposure can give you a really balanced and really what we call high quality returns. So that's effectively lower volatility in your returns, smaller drawdowns, and better upside is the best way to sort of put it.
Great. Thomas, maybe let's touch a little bit on some of the investing strategies that the different crypto funds use.
Sure. Really kind of adding on what John said, I think one thing that is very interesting is outside of the completely kind of new opportunities that crypto offered, and actually crypto means a lot of things for different people. But the reality is that you can also find a lot of existing or a lot of strategies that have disappeared from traditional market because these markets have become very efficient. And it's kind of rolled you back to the real opportunities you had from, again, alpha extraction and liquid alpha extraction that most of us have seen, but probably towards the end of it, like 20 or 30 years ago. And I think this is what's extremely interesting on one end of the spectrum, which is liquid alpha, extremely high Sharpe ratio that you can bring back into your portfolios as a global allocator. And then on the other end of the spectrum, you have the very explosive kind of growth-oriented, kind of visionary type of exposure into VC type of investment that potentially are highly risk, but also high octane. And what it offers to all investors, again, as John mentioned, is is the capacity to kind of cherry pick the exposure you want to build for yourself into that kind of brand new asset class, which I think is one extremely refreshing for, in general, any asset allocators. And if you look at the journey that we've all gone through over the last 3 to 5 years, and the broader adoption that is currently taking place with, in general, kind of any type of institution, I think they're all going to go through the different phases and then cherry pick which kind of part of that ecosystem they feel more comfortable with. They all come with different risk reward, and ultimately it's not only about kind of bidding specifically Bitcoin or altcoin or whatever. It's really finding the spot and the type of profile you feel comfortable with, and then constructing a solution that is robust enough to have the staying power to extract that type of return. And this comes really with the same type of expertise that you would expect from any traditional players. So to be specific, you have strategies in arbitrage. The very basic one will be like just Bitcoin arbitrage across different trading venues. Even though these strategies seems to have been upped away in most of the time, when you have a bit of volatility in the market, which in our space happens like almost on a daily basis, suddenly you have windows of opportunities, right? And if you think about the evolution of these markets over the last 2 to 3 years in terms of derivatives and options, this is creating a lot of more opportunities again. So arbitrage is obviously a very big part of what people are going after. You have trading. What you need for traders is liquidity and volatility. I mean, obviously we have a lot of liquid tokens and instruments out there, and volatility is there. And finally, you have what you call the fundamental kind of stock picking approach. And with almost 10,000 tokens listed out there, you have a lot of opportunities for cherry picking and for good alpha generation for people that have a bit of a mid to long term horizon in the investment. So a very interesting space.
It is indeed a very interesting space, and there's a lot to sort of take in and understand. My next question is actually for Sunil. Look, I mean, Gemini serves a whole range of investors, whether it's sort of the retail investor to the institutional investor. What are, some of the, how is Gemini looking at institutions, and what's the interest from fund managers across traditional as well as the new crypto type asset managers, and what are you seeing?
Sure. Thanks, Oyi. So just like you said, right, Gemini has a healthy mix of client types, including institutions and retail both, right? And then for institutions as well as for ultra high net worth individuals, we do offer a white gloved service, which basically includes account management, sales support, bespoke trading services like OTC desk and world-class custody solutions, as well as API connectivity and so on. We also operate a hub and spoke model. So essentially, we have people on the ground. So one thing to note about Gemini is that we are probably the largest presence in Asia Pac. On the ground, we have 38 people now on the ground in Singapore, and that's amongst the regulated exchanges, one of the largest presence that you would get. And then we also offer something which is very unique for institutional investors called master sub account feature. I'm sure like any institutional client would basically appreciate this accounting segregation, or even at a custody level, the segregation that this can offer. So this is a good technical solution for maintaining, let's say Tom wanted to run arbitrage strategies, or he wants to run, let's say, cash and carry strategies and so on and so forth. So, and, our kind of platform is able to give him that functionality. What kind of institutional interest we are seeing? I mean, I would say we are seeing asset managers, we are seeing ETFs, especially in North America, but increasingly even in Asia. We're also seeing a lot of interest from wealth managers, family offices, liquidity providers, and public and private corporations. So it's a fairly large gamut of interest that we see, and of course hedge funds and so on as well. And for example, to give you a sense of the growth, our Asia business this year has been pretty exponential and is very easily in the high triple-digit percentage growth. So that kind of gives you a sense of how much crypto adoption is happening, but also the participation from institutional clients is definitely on the increase. And, that kind of also shows in the price action, if you like.
Thanks, Sunil. The next sort of portion of Q&A we want to go through is actually, do you do it yourself or do you have it professionally managed? I think the first question actually is maybe for those who are still not over the fence yet around crypto, is a question for you, John. How does crypto fit into an individual's investment portfolio?
Good question. So it depends on what individual you're talking about, first of all, right? I mean, like we deal with high net worth, family offices, and then major institutions, so superannuations, pension funds, etc. I'll start with the top end of town, the pension funds, and work back to sort of where it fits probably in the high net worth. But, the institutions right now, I think everyone's pretty aware that there's been a dynamic shift, right, in their view on digital assets and where it fits. There is an overarching thesis, the end of fixed income, what we're going to do with monetary policy going forward, and are digital assets in a form of alternative duration, right? And can it form part of someone's portfolio? Not to be a huge component, but effectively a sleeve of their fixed income portfolio that gives them really uncorrelated returns to traditional asset classes. So the way we see most of our institutional investors looking to allocate to this space, it adds as a diversifier, right, to their existing portfolios. They generally look at it as like a really efficient use of capital because it's a highly volatile asset class. So they look at it and say, we can put 1 to 3% of our risk capital into this thing, but it may give us 10 to 15% of our returns because of the sort of performance you do witness from it. But they don't generally deal or drill down into too much of the underlying utility. And this is sort of why I was sort of going down the curve, because when I look at digital assets, you do need to understand the utility. And obviously Bitcoin is probably, obviously the most well-known digital asset out there. And, a lot of people view it as digital gold, whether it's a replacement for an entire settlement layer and payment infrastructure around the world. Listen, I definitely think it is. And obviously you've seen countries like El Salvador do exactly that. But I think when the institutional clients look at it, they bucket Bitcoin, Ethereum, Solana, everything together, and they say, listen, this is a correlated asset class. They just say, we want merely an index product that gives us exposure to it. But when you go down the next level, you actually find significantly more sophistication in the family offices or the high net worths who generally have done a lot more work, generally understand the asset class and where the disruption could come from. They may even have a thematic that they want to be focused on. It may be something like DeFi. It may be something like gaming, for instance, or NFTs, as I mentioned before, or even, the disintermediation of asset management, right? And there's obviously a lot going on in that space. We can find that people like to play in a more thematic or venture side of things, where they sort of want to look at the sort of long-term price horizon of these assets. And then something we do is more around sort of yield farming. So that's nearly an alternative to fixed income products. So for them, they're looking at it and saying, listen, we need something that's giving us a derived yield. We actually don't even want the price volatility of Bitcoin. We don't want to invest in, the price appreciation of Ethereum, but we want to extract value out of this ecosystem, the continual growth of, total value locked in DeFi. So we do see a very different, I guess, viewpoint at that sort of family office and high net worth. And then at the sort of, I guess, at the lower level, of allocation, I think a lot of people have definitely woken up to, I don't want to miss out. Like there is a little bit of FOMO in the market. It is a little bit of an emotional market, I would say, when you get down to the real retail level. Their friends own some, they see it going up 50% type thing, and people sort of jump into it at probably the worst time. And then when it dumps, 20, 30%, they're selling it because it's nearly an emotional charge. Whereas we try to do as a fund business is give them, once again, that sort of quality return. So it's, hopefully don't take the emotion out of it and give them just like what we think, it's a 3 to 5 year investment. You want to see this grow over time and don't worry about the daily swings, right? Believe in the story, and that's how you should be allocating.
Okay, well, let's ask an independent sort of exchange. Sunil, would you recommend buying our investors or our participants here, buying crypto directly or via crypto funds? What do you think? What would you say would be the pros and cons that people should consider?
Well, I'll try and answer in a very unbiased way, right? Because the funds are my clients, and so are the direct investors. So look, I mean, I don't have I can just tell you pros and cons, right? So basically, pros wise, it's clearly a diversifier, right? So if you invest through funds or ETFs, it gives you a broader exposure at one go. So it's definitely diversification within the crypto space itself. It gives you broad exposure to the asset class. It's less hassle. So and then of course, one other thing that you would potentially invest in a actively managed fund would be its potential outperformance, right? So if the fund has a track record of potentially outperforming whatever benchmark it's set. So if the benchmark is Bitcoin and they have strategies that they spell out and they have a track record, or as John just said, they have yield farming strategies and it kind of beats your fixed income returns by a mile, or it could just be outperformance, right? So basically look at benchmarks, look at what the drawdowns are, and do a bit of due diligence like you would for any other asset class, right? Look at what the returns are, look at what the Sharpe ratios are, and basically go from there. And of course, look at the track record of the fund managers and so on, and if you know them, that's even better. Now who goes in for direct investments? A well-researched buyer who would basically go and do direct exposure. It makes more sense because it makes him more nimble-footed and he's able to take advantage of market moves. So it just depends on whether you are a savvy investor or you have the time, effort to put into actually going and figuring out stuff. Like again, it was mentioned that there might be security issues, right? There might be do you know which is a good regulated exchange? You keep hearing news about this got hacked and stuff like that. I mean, of course you want to avoid all those pitfalls. So I would say do a bit of like in any other asset class, right? Do a bit of research, try and understand the space before you go into something like crypto. Now, the other thing is that if you invest through funds, you don't get direct ownership. So there is a little bit of utility element to crypto, right? Eventually, we hope that some of the cryptos are used for payments and so on, right? So you won't be able to do that. So that's one other thing. It's small right now, but hopefully it'll become bigger. And then of course you have to be looking at management fees and saying, is this fund adding enough value to me? So again, like look at what the performance has been and so on. So those are the pros and cons to me. If you understand the space well, if you are able to do research, if you are able to figure out, be connected to the market, by all means go and look at it directly. But again, like I know of family offices who, like for example, who invest in equities, who have direct equity exposure, but they say beyond a point, I want to also look at some of the funds, right? So there is space for a few things in your portfolio, depending on the time and effort you are willing to put into, and this space is great. Like, if you have the time and effort, do put in the time and effort, because you would figure out things that are just evolving, and people are like John and Tom. We have come from traditional asset classes, and we think it is an exciting asset class where putting in our full time is making a lot of sense. So yeah, very exciting on both sides of the coin. But take your call depending on how much time and effort you have and how much due diligence you can do, both on the funds as well as on direct exposure.
All right. Well, speaking about value add of funds, Thomas, the question for you is, how do crypto funds manage risk as compared to the average investor? And do you think crypto funds will outperform crypto? It's an interesting one.
Sure. Yeah. I mean, a pretty broad question and but an interesting one. So, I mean, first of all, I guess a bit of a disclaimer. I think there are a lot of funds out there. They're obviously not all equals, and you can find very good funds, which we're trying to, and you can find funds that are just average, like in traditional finance. But I think what people may not realize is the amount of good quality managers and processes that have been kind of looking at this space. When we started looking really for the first time, roughly 4 years ago, I'd say there was still a lot of unstructured shops, props, and people kind of trying their luck at the space. And it has grown up in terms of, and not only in terms of the managers themselves, but people kind of serving this ecosystem, what we've built, what Gemini has built, and what all the other players have built as well. So it has grown up in terms of maturity and quality, in terms of all these risks and processes a lot, which, while I fully agree with Sunil that people could definitely spend the time, the effort, and the energy to be competitive against some of these professionals kind of setups that are looking at opportunities in the space. I mean, the barrier to entry is getting higher and higher every day to go after those opportunities. I mean, certainly the asset class is still very much in its infancy, and you can pick a Solana last year or even this year and still make a 2 or 3x. And if you picked it up last year, as many of our managers did, you'd done like a 60 or 200x, which is a big different number. So I think there's still a lot of juice left in the system, both in arbitrage or directional. But what people don't realize is that actually paying the extra cost of being in the capable end of people that have been dedicated the last few years of their career in the space makes a huge difference over the medium to long term. And this we're pretty convinced. That said, we'd love to. I mean, we love to have more people involved directly as well. This creates a vast amount of opportunities as well. As John mentioned, obviously FOMO is a big part of this ecosystem. It creates risk for those who can't handle some of the instruments that are listed. It creates opportunities for those who can. And so I think you can just take one piece of the ecosystem and just zooming it out from the rest. And so risk, ultimately you have two major risks. You have investment risk, which is how you deal with instruments that can basically drop in value by 60% over a few hours, as we've seen, or maybe a few days, as we've seen this year, last year. And I think this is something we've never seen in other markets. I mean, the capacity, the drawdown capacity, the deleveraging impact that we can have in some of these instruments is just massive. And I think outside of professional kind of traders or people that are really spending the time and the effort, a lot of people are being kind of burned by these kind of characteristics. So one is investment risk. The other obviously is setup and operational risk. And John related to the interaction, the third parties that you need from a fund setup perspective, but also, I mean, which trading venue you're going to choose, right? I mean, we know how we build our own. We know that there are other kind of good trading venues out there like Gemini. And we also know that there are others that are quite risky, frankly, and you don't really exactly know how they operate, how you're going to get liquidated. And so just doing the proper due diligence on where you're going to trade, how you're going to custody your assets, et cetera, it takes a vast amount of time. And so when you pick managers, as we do, essentially you spend, let's say, 50% of your time trying to pick the right players, and you spend 50% of your time making sure that the way they trade is actually done in a fashion where they limit the risk that they have in terms of counterparty operational risk. So I think this is what the fund's setups are really adding to the equation, from both understanding the market, deploying the alpha strategies, but also trading it in an as safe as possible function, both from an operational setup and from an investment setup. In terms of, I think the second part of your question was, you think they're going to beat the market? Well, first of all, what is the market? That's number one. And two, how do you qualify the definition of beating the market? Is it just printing a better number? Or actually, is it kind of, as, and I think, again, John mentioned it, is it a better risk reward, right? Is it, like, for instance, if I look at what we've done, to give you like a broad idea, but when the market is down 60%, if you lose less than 5%, is it, but ultimately you might be lagging the market when it goes up like 3x. does that translate into a much better kind of long-term experience for investors? I think it does. So from that standpoint, from a risk-adjusted return, I think all the qualified investors out there that are doing the job they should will be beating this market, because the volatility of this market creates a ton of opportunities to actually do it better than just buying and holding for many of these coins. So this I'm pretty convinced. So I think there are a lot of ways for these managers to outperform, and hence to justify the fees that they're going to charge. Because one big question that you have in traditional finance is, why would I pay for exposure to such and such? Why would I pay a hedge fund manager? Well, the reality is that if you can really improve your long-term risk reward, that's the only reason why you should pay. And I think in this space, you have, I mean, we've seen it. We have evidence of that. A lot of shops actually deserve the fees that they charge.
Thank you for that. Obviously, we see that across the traditional asset management industry as well. It's quite interesting to see what's happening in the crypto space. I see we have a lot of questions, and I think we've asked if people wanted to upvote the questions. But before we get into the Q&A, I wanted to run two controversial topics, which oddly hasn't appeared in the Q&A. And I'm going to go through the three speakers. I'm just going to combine both of them because I think they're sort of a little bit in the same boat, which is what is the impact of China banning cryptocurrencies, and where's the market going from this, this announcement of the ban? And second, actually at a broader level, how do you think crypto will meet the regulatory challenge? Let's start with Sunil.
Yeah, so short-term impact of any such news, right? Any large user base that has kind of adapted or adopted to a particular underlying or asset, if they are kind of forced to sell, then of course it's going to be negative. So this is what we saw back in, was it 21st of May, right? So I remember the price of Bitcoin at that point was about $37,000. And then, of course, we saw the price move a little bit lower as the first round or second round of selling kind of went through the system. And then, we are sitting here today at 54,000 BTC. So, I mean, I saw an interesting chart, right? I mean, basically, every time you had this kind of China ban announcements, you kind of had, so I have some stats here, right? So basically, we've had like the first ban was on in 2013. It was 12th of May 2013, and we've seen Bitcoin annualized returns of 59 or 60%. So basically, and even from the latest round, now we are at about 36, 37% higher. So, again, like, as I said, if you have these kind of moves where you have a large pool of investors who potentially have to come out and sell, then you will have negative impact in the short run. But if you keep believing in the story, and the adoption is real, we see the adoption keep increasing, and it's kind of becoming a proper mainstream asset class. You would tend to see this, you would tend to see things bounce back. Now, I need to caveat this, right? Or, this is not investment advice, and, please consult your investment advisor before you put in any of your investments, because it is a particularly volatile asset class. The walls here in this market are about 100% versus traditional asset classes like NASDAQ. The wall is currently at about 22%. Normally it's about 17-18%. S&P normally is 15, and right now it's about 19. And then single stocks have volatility of about 35 to 40%. So it is a particularly volatile asset class. I would be a little bit hesitant to put on leverage and so on in these asset classes. And you should be thinking, you should be able to hold through some of these volatile periods. So yeah, so that, those are things to kind of definitely look out for. Now, in terms of regulation, I mean, from Gemini's perspective, we are built for regulation. Like, 2014, the Winklevoss brothers, basically, they, the reason they kind of founded Gemini was so that there could be a very secure platform to just hold their own assets, because they couldn't find much in the market at that point in time. And they built their best because, it was their own assets. And then we kind of rolled out to other people in the market because it was a very good solution. So we have embraced regulation from day one. We actually are probably the most regulation friendly platform that is there. We we believe from day one that we would rather ask for permission than forgiveness. And so we are now regulated by New York State Department of Financial Services. We are also regulated by the UK FCA. We operate under the exempt category for in Singapore under MAS's PSA, and we regularly engage with regulators across the areas of our operation to make sure that we kind of are towing the line, basically, clarifying issues, and we want regulation to come through, because it does weed out unwanted players, unsecure kind of platforms. Like, think about it, right? The whole banking ecosystem is perceived to be very secure, because you have regulators who are checking whether the systems are good, whether people are doing what they suppose, their policies, processes, security systems, compliance, all those things are properly checked. What we would like to do is basically have the same thing in the crypto space as well, and then that would basically bring a lot more trust to this system, and then the adoption would increase even further. And even institutional participation, like we see institutional participation is there, but the traditional institutional participation is, even today is lacking a little bit. Like, look at how few private banks actually offer crypto as an offering. And that kind of tells you, if it was more regulated, then they would probably embrace this asset class even further. And so I have no doubt that regulation is something that we would embrace, and we would like the sector to be looked after by our regulators.
Thanks, Sunil. Thomas, your views? China and regulatory.
Well, I'm certainly not gonna go into the direction of calling what China next move is gonna be. What I can just relate to is the impact on the market. If you just look at prices, well, prices have done what they've done. More interestingly and more important for us is how volume have behaved and kind of different trading venues. So there hasn't been like any major stops or hiccups since the kind of official announcement of what was cooking anyway for a few months already. So I think a lot of these things were relatively well telegraphed, and many trading venues, obviously not all trading venues are equals in terms of how they deal with compliance and regulatory kind of needs. But I think in general, this has been kind of maneuvered relatively okay. It's certainly something that, the essential thing is that managers have to stay fluid. They have to monitor those risks on an ongoing basis, to have multiple options to move assets if need be and when they can. I think it's very similar to financial crisis back in 2008. Suddenly people realized that many of hedge funds only had just one custodian, and nowadays everybody knows that. Basically diversifying your risk of counterparty is rule number one. So I think that's something that's very true here. So the other thing is that on one end, some of those kind of statements are going after one piece of the ecosystem, and not necessarily against all of the ecosystem. One thing that John mentioned initially was that actually cryptography and blockchain do serve multiple purposes. We're talking about the investment and how you basically invest on some of these projects and make money out of that. But essentially, many of these projects are actually kind of backbones of solutions that are being used by industrials more than anything else. And this is completely different to what's been kind of discussed from a regulatory standpoint as well. So it's very difficult just to touch on one specific aspect without killing the rest. And it feels like it's very difficult to go against the efficiency and the benefits of those blockchains. So that, I guess, number one. The other one regarding regulation, I mean, we're all kind of waiting for more regulation. It's gonna make the market more efficient, which is gonna be negative for me because I love inefficiencies and that's better. But the reality is that the supply of inefficiencies versus the demand, and we would just, I mean, first of all, we've been built around regulation, very similar to what Sunil kind of mentioned. We embrace it, we want more, and ultimately, I think that's where it's definitely going. The whole ecosystem is to the point where it can be ignored. I don't think it can be killed at all. So it will have to be addressed, and this is what's being kind of basically taking place over the last few years, which I think it's a very big positive. And also fully agree that those who haven't embraced regulation from the get-go, is going to be very, very difficult to go back and say, well, by the way, we're trying to do things the right way today. And I don't think regulators have a tendency to forget. And I think not only for institutions, but for people that were involved also with those institutions in the first kind of tranche of the 5-10 years, I think it's going to be no go into a properly regulated world. I think what's going to be very interesting is the whole DeFi and properly decentralized kind of venues and functions, how this is going to be tackled by regulator. Because one way or the other, you might claim that you're fully decentralized, you'll have to fill into one of these buckets of regulation. So I think that's going to be something we'll be paying close attention to, because that's going to be extremely interesting.
Thank you, Thomas. John, before we get to Q&A, what are your views?
Listen, I agree wholeheartedly with what Thomas and Sunil have said, particularly on the regulatory front. I'll just touch on that lightly. Obviously, as I mentioned, I sit on the board of the Digital Finance CRC, which is a federal government-funded research center into like the digital economy, right? So we work with regulators, we work with wholesale CBDCs. We look at really the challenges that Thomas was just highlighting around what you do with decentralized exchanges and how you're going to effectively consider tackling it without stifling the innovation. And it is a major issue, but from my perspective, I think regulation will be good. And I think China banning cryptos and banning mining, I'll come back to mining in a sec, but banning cryptos is probably a net positive, because I think the US in particular may pick up the torch and run with, we want to be the champion of this innovation, and actually, if anything, accelerate it by accelerating it through regulation in an efficient way. So to me, it's a net positive, but like all things in digital assets, there is a bit of emotion when these announcements come out, and it does swing around. Just quickly on the mining ban, one thing that, it obviously created a bit of negative price action as well, but a lot of people forget that China banning mining is a net positive for particularly the Bitcoin network, because it strengthens the network, right? You're actually making it more decentralized. So you're moving a lot of the miners out of China, or all of the miners out of China, and they haven't all just gone to North America. They've gone all over the world to where there are, one, renewable energy sources. So a lot of it's on gas flaring, hydro, solar now, for coming straight off coal. And two, you're moving into democratically elected government nations where you can't just ban a commercial enterprise. So to me, you got a stronger, more efficient network off the back of China actually pressuring this. And two, I think actually innovation will accelerate with the regulatory environment getting stronger in this entire space.
Great. Well, I see we have a lot of questions coming through, so I'm just going to sort of quickly get into it, and I'll probably just sort of maybe pose a question to one of you, and then if the other have a point of view, you can raise your hand. The first question that seems to be very popular is about staking, and I think this is something that John mentioned, so this will go to John. What are the risks involved with staking, and yields can appear to be too good to be true sometimes, and is that a correct statement?
Yes, that is the correct statement. So yeah, there are a lot of risks involved in staking and yield farming, and when you look at it, they are different things. So you need to know the different risks. I'll talk about the yield farming because I think it's better to talk about what we're involved in from a fund perspective, but it's very similar in deriving yield. I mean, when you think about your yield farming, there's obviously smart contract risk. So there are bugs in smart contracts, right? So the point I made before is we have a whole technology arm that looks at smart contracts. And so obviously being able to have that experience and look for where the bugs are, speak to smart contract auditing firms and understand where those smart contracts have actually been audited, understand, like, for instance, how they do liquidity events. So, whether it's a bid or an auction, is it sold at a discount when, these pools are liquidated? The other potential risks in a lot of these pools is they have nearly systematic risk. So, systemic risk. And what that means is your one pool, when you're pledging your asset, they're then restaking that asset into another pool, right? And then it gets restaked and restaked. So they're nearly all connected. So, people talk about too big to fail. And in some of these pools where they're saying, hey, we're giving you, whatever, 30% return, and Curve Finance is giving you 9%, there's a reason. And the reason is that same asset is being effectively restaked and repledged along all these different pools, and you're creating nearly a systemic risk in the entire system. So understanding those pools and that liquidity comes back to actually the point Thomas made before about, actually answer Neil, about whether you go with a hedge fund or a mutual fund or do it yourself. I think you can do a lot of this stuff yourself, definitely, but it comes back to doing the groundwork and understanding, some of these risks, whether it's composability, smart contract risk, whatever it might be. But there are a lot of risks, and they're I guess the core thing. The last thing I'd add is, obviously the security of your keys. You do need to know how you manage your keys, how you manage your physical devices, whether you're two-factor. There's obviously SIM swaps and all this sort of stuff that goes on in the marketplace these days. How secure is even your email, right? This is how hackers get into a lot of your information. They get into your email, they speak to the phone company, they change your SIM, all this sort of stuff. So, having that security around your underlying assets is pretty critical. So it's not just in the staking, not just in the yield farming, it goes all the way down the chain. And how you manage it.
Right. There is a very interesting, of course, there will be a question on Bitcoin prices, but I will leave that right to the end, and I'll just make your go, yay or nay. But one of the questions that I thought was quite interesting around funds is we have an investor here who is looking at crypto funds, and I'll throw this question to Thomas. But unlike traditional asset classes, where the valuers are obviously, it's a very established fund administration and valuation process, what is your view about the trust level at the moment on third-party service providers that are providing this fund reporting to investors? And do they have actually enough experience on, the underlying NAV of the crypto funds, especially, if there's a lot going on, staking, yield farming, or, even NFTs? Thomas, could you respond to that?
So I guess there's two parts of the question. Is one the service provider and one the valuation of the underlying assets. The service provider, you can find very good service provider in the space that have sizable businesses in traditional kind of administration for hedge funds, traditional funds. So I think this is all about finding the manager who's decided to pay the price and do his homework and due diligence to find the appropriate administrator. And there are probably a good handful of administrators that are extremely professional and of good quality. So I think getting the third party involved to price your book is a done deal. This can be done by anyone. Then it gets to the valuation of the underlying assets. Well, if the book is investing into listed instruments, derivatives of Bitcoins, whatever, any listed instruments, the price discovery is there. Then it's about deciding what's the threshold of how much is really traded and is that trading kind of real volumes. But again, the price discovery is relatively simple, if not to say kind of extremely simple. Then you go into, NFT, well, what's the real value of some of these instruments? It's the same for any kind of non-listed, non-visible, non-easily kind of price discovered instruments in traditional finance. So what's the price of a painting? What's the price of an NFT? I'm sorry, but that's going to be the same kind of discovery process. And what you should make sure is that there are real third parties or independent third parties that are involved into the pricing of the different instruments of that specific vehicle. That's number one. Number two, which I think people miss completely, is that it's not because it's tokenized or it's a crypto that it's liquid. Let's be very clear. And so if you're pricing a book on a daily, on a weekly, on a monthly basis, but actually there are no transactions of this, and you're just pricing it out of thin air, the day you're going to need that liquidity, you'll be in for a pretty good surprise. And it's all about making sure that those things are aligned. I mean, if the fund is actually structured as a VC or PE fund, and you don't expect liquidity before 5 to 7 years, then you probably, I mean, you're fine. I mean, you obviously want to make sure that the pricing is there, but it's not the same type of risk than if you're basically dealing with a fund that is providing liquidity to potentially other investors while you're staying based on pricing that are potentially artificial. So obviously there is due diligence that has to be taken by the end investor to make sure that all these processes and every credible fund, and actually it's a requirement for many jurisdictions, needs basically to make public their NAV calculation policy. So just ask for it and look into it. And then once you look into it, confirm it with the different parties involved that is actually part of the agreement that they had with the fund manager. And you'll be surprised that it's a very relatively simple kind of process, but very often you kind of uncover quite a few discrepancies between what's been told to you basically and the reality.
Thank you. So now this is a question for you. In the case of exchange interfaces, what kind of features do you think should be integrated on such exchanges to improve the handling with trading, and where do you see the potential of improvements in terms of the interface and exchange experience?
So what kind of things can be integrated? So clearly, one, you have the trading platform that's serving the clients, but essentially you could integrate custody, for example. So of course, exchanges would then come with their own hot wallet. So essentially you have the hot wallet associated with the trading. Then you have custody, that would be the second one. The third thing that can be integrated is products like lending or borrow. Like basically you could lend your crypto, or you could lend your stable coins to through that platform. So again, those things are clearly things that can be integrated. One thing I would mention is that we do all of this stuff. So we have these programs like Gemini Earn. We have our own custody solution, or it could be another custody solution. But integration is important, because that kind of gives you that one platform where you can seamlessly transact. The other feature that clearly needs to happen, and which does happen with some of the exchanges, is on-ramp of currencies. So for example, we have about 10 currencies on-ramp, where you can transfer dollars or GBP or euro or Aussie or Sing or Honky. So basically, those are the things that clearly can be integrated within the system. And last but not the least is staking, right? So essentially, those are things that are exciting. And if you can have that in one ecosystem, then that obviously makes it that much more powerful. And one other thing, NFTs, like that's coming. So yeah, so all these things can, like, having one integrated platform can make it very very seamless experience for investors.
All right, we're running out of time. I'm going to ask one last question. It'll just be a quick round. Just give me 2 altcoins that all 3 of you find, or well, each of you are looking at and find interesting at the moment. John, let's start with you.
2 altcoins. All right.
Yeah.
Definitely not investment advice.
No, definitely not investment advice.
No, I'm a big fan of Algo and as well as Phantom.
All right, Thomas.
It's a very difficult one for me. I think Solana definitely has, even though it's run a lot, has a lot of potential. But actually, I still keep. It's not an altcoin, but I have to say Bitcoin.
Right, Sunil, what are your 2?
Again, not investment advice for sure, but I like Solana and I like Polkadot. And then I'm very excited about ETH 2.0. I mean, from a utility, I look at this stuff from a utility perspective, as John had mentioned earlier. And you look at the utility of some of these things, like the adoption is very likely going to be there. So yeah, very excited about those.
All right, this is the last one, and just a yay or a nay. Where do you think Bitcoin will go? Let's say in the next 6 months, this or this?
Well, we are an exchange. We don't predict prices, but our promoters.
Personal view.
Yeah, so the brothers came out with BTC 500,000 as yeah. So basically that they came up with that research last year. So you can read that up. I think that's really the closest we can come to talking about prediction of prices.
All right, thank you so much, gentlemen, for joining me. What we will do, I know we had a lot of questions we couldn't cover. I'm so sorry about that. But if you would just email Alexander Lee at addx.co, and we'll see if the speakers are willing to sort of answer them offline. Otherwise, I think Alex has one last slide to show everyone, just in case you've been excited about, sort of the ADDX platform and what we might be doing here. Please either reach out to us, scan a QR code, sign up on our app and see what goes on in there. That would be fantastic. And for everyone else, thank you. I know, it's an early day for Thomas and John. It's a late evening for you. So thank you so much for joining us. Thanks, Sunil, for joining us. And we will see you very, very soon. Thank you, everyone. Have a good evening.